If the stock market returns 10% per year and you own a triple leveraged ETF tracking that stock market, what return are you going to get? Most people would say 30%. 10 times 3 equals 30. However, that is not actually the case.
This video is for educational purposes only. It should not be considered investment, legal, or tax advice. It is not an offer to buy or sell any security. Past performance does not indicate future results. Investing is risky.
The only way that's the case is if there is no volatility involved. In all cases with a stock ETF, there is volatility involved. That means the actual results you're going to get are not 30, but usually something less. To understand why that's the case, we need to do an illustration. Let's say we have an investment that we put $100 in at the start, and every single day for 30 days, it goes up 1% and then down 1%. Up 1% and down 1%. If we repeat this pattern for 30 days, we would have 15 up 1% days and 15 down 1% days. Intuitively, you might think that 15% positives and 15% negatives should net out to 0%. However, because of the mathematics of compounding, that's not actually what we see. $100 going down 1% goes to $99. If we then go up 1%, we get to $99.99. If you go down 1% from there, you get $98.99. If you go up 1% from here, you get $99.98. So if we repeat this for 30 days, what you end up with at the end is actually $99.85. If we were to leverage this investment 3 times, the volatility has an even worse result. $100 going down 3% equals $97. 97 going up 3% doesn't get back to $100. It only gets back to $99.91. 3% down from there is $96.91. And if we repeat this 30 times, we end up with $98.66. If we make this even more extreme and assume plus 10% minus 10% days, we actually end up with $86.01. The more volatile an investment, the lower the actual compounded returns are going to be. Even in our example here, when the average return was 0%, the more volatile investments actually ended up going down. That's why a leveraged investment is not going to generate the kind of returns that you would expect by whatever the leverage amount is. To illustrate, let's assume we have a market that goes up 2 days in a row by 3% per day, and then on the third day, it declines by 5%, and it just repeats this for 30 days. So our $100 investment grows to $103 after the first day, and then a little bit more than that, $106.09 in the second day. Then it declines by 5%, bringing us down to $100.79. Then we go back up another 2 days, taking us to $103.81 and $106.92. And we repeat that for 30 days. We end up with $108.14, which would be a return of 8.14%. Now let's say we had the opportunity to invest in this as a leveraged ETF. You would assume that the return for this should be 8.14 multiplied by 3, which would be 24.42%. However, the actual results are much different. Our $100 investment goes up to $109 in the first day, which is triple this return. In the second day, it goes up to $118.81. The second day, however, the leveraged 5% loss drops us 15%, taking us back down to $100.99. 2 days later, we're back up to $119.98, and then back down to $101.99. At the end of 30 days, this actually ends up being worth a little bit more than the unleveraged investment, but it's only worth $110.34, which is a return of 10.34%. Nowhere near the 3 times return we expect it to get. And that is why a lot of these ETFs, if you look in the fine print, they say that they are not for holding over any longer than a 1 trading day period. And the reason is because of this compounded effect. You end up getting the triple return on the first day, just like we did here. However, as you introduce compounding into the picture, the long-term returns end up being a lot different than what you might expect. There are certain cases where the leveraged ETF can generate long-term returns, and those occur specifically when you have a long string of positive days with a lot fewer big down days. TQQQ is a good example of that. The 10-year returns are 60.9%, and that is an annualized return, which is just ridiculous. And here we have the QQQ ETF, which has delivered 22.83%. So in TQQQ's case, the bull market, the 10-year bull market, really longer than that, in QQQ, it's been such a good long string of positive returns that the leveraged ETF has been able to almost, not quite, but almost deliver triple the results. However, if you get into an environment where returns for the underlying QQQ aren't as friendly, that or they are a lot more volatile, then TQQQ is not going to deliver as good of results as advertised by the triple leverage. So you're basically taking triple the risk and not getting quite triple the results. And how much less you get just depends on how volatile the period can be. So just be aware of that before you invest in leveraged ETFs. Covered call ETFs like QILD are another asset that are very widely misunderstood. In this next video, I'll explain how covered call ETFs like QILD work, some of the risks, and some of the reasons you might want to consider them for the portfolio. And just a spoiler, it has nothing to do with income. In this video, I'll explain why.